Okay, great. Hi, everyone. Good afternoon. Thank you so much to everyone who's joined the webinar. We're very excited that you're joining us, and we're happy to have you here with us today. I would first like to start off by introducing myself. My name is Hanan Taifour, and I work for SheTrades under the SheTrades Invest project. Before we start, I'd like to go over some housekeeping rules, please. It would be great if everyone could keep their cameras off, and please keep your microphone on mute as well. It will just help us have a smooth session. I'd also like to let everyone know that this webinar will be recorded and the PPT will be shared after the webinar. So you can look forward to that in the next few days. And lastly, I'd just like to point out that we have 2 evaluation questions at the end. I will put up the questionnaire at the end, and it really shouldn't take more than 30 seconds to a minute. And please do take the time to evaluate the webinar for us. It really helps us to improve the webinars going forward, so your input is really valued. I'm just gonna go on to the next slide. And just start by introducing the team. Well, before that, for this session today, we have Heva Fund, who will be talking about their products and services. And this is the SheTrades Invest team. We have Anna Mori, who is the project partnership manager, Leticia Johnson, who is the project coordinator, Marco Alatelli, who is our access to finance expert, Nina Jessen, she's the team's communication expert, and lastly, myself, and I am an advisor and also the Mo Brahim Fellow for this year's intake. I'll also go over what SheTrades does and what it aims to do. So SheTrades aims to connect 300 million to market by 2021. And under the SheTrades initiative, we have a program called SheTrades Invest. And this program aims to connect women entrepreneurs and make them more investment ready. So hence the objective of this webinar, to give you more insight into financiers and gain more about their due diligence process, their products, and their service offerings. Okay, thank you. I'll stop sharing my screen now, and I'll hand it over to Kendi from Heva Fund. May I please ask you to share your screen and share your bio and talk a bit more about yourself and Heva Fund.
Sure. Just give me a minute. Are you all able to see my screen? Hello, Hanan, can you see my screen?
Yes, I can see your screen.
Okay, thank you. My name is Kendi Kamwambia.
Kendi, your mic is a bit low. Can you, yeah, okay. Maybe if you speak now, let's just quickly test it.
Let me, can you hear me now?
Perfectly, perfectly.
Okay.
And yes, and you can just put on presenters mode the webinar.
All right. So saying my name is Kendi Kamwambia. I'm in charge of support and compliance at Heva Fund. I'll start by doing a brief introduction of Heva Fund and what we do. So Heva Fund is a creative economy catalyst fund. We are the first it's the first of its kind in Africa, where we are dedicated to finance, to offering business support, and to the creation of knowledge facility for the creative industries across Africa. And so how we go about our mandate is through our 3 intervention arms, which are finance, business support and capacity building. And then we have the research and insights arm of our interventions. So under finance, what we do offer seed grants and seed financing to very early stage businesses. These are businesses that have been in operation for less than a year. We also have the SME level level of financing, but it's not the SME, the standard SME ticket sizes, or you don't expect to find the standard SME type of businesses in this sector, because the creative sector is very nascent. It's still in its early stages. So what we refer to as SME is a bit smaller in size and in revenues as what is considered SME in the normal context. And then we have growth facility. We have a growth fund facility. Here we offer ticket sizes of USD around 20,000 USD dollars to 50,000 or to actually 100,000 US dollars. And so this facility is divided for the Kenyan market, and we have also another facility for the East African market that is set to launch in 3 weeks. And so we'll be investing in Rwanda, in Uganda, in Ethiopia, and Tanzania. Our business support and capacity building, we do run workshops for the creative economy. We have workshops that are centered around business and enterprise. So these are workshops like bookkeeping, human resource management. We also have workshops that are centered around technical skills. And here we go deeper and talk about, we do workshops on mostly how to become better at editing photographs, how to deal with lighting when you're doing photographs, how to stitch, how to pattern, draft or make. And so those are the 2 ways that we do our workshops. There's a third way also for our workshops where we offer access to market. And so we invite or sponsor people to go to international market fairs. We host pop-up markets as well for the region. We sponsor people to go to, let's say in Kenya, for a BizBus, it's called BizBus fair. Also in our MOU together with SheTrades, we are hoping that once everything normalizes and they select the businesses to go and showcase, let's say in their international market fairs like New York, we are hoping to offer production facilities for the finalists who make it to showcase. Our third arm of intervention in this sector is the research and insights, where especially in Kenya, when we went to the government to ask them for some policy changes or for them to fill in some policy gaps, they kept referring us to the lack of data in the ecosystem. And so what we did is that we embarked on research on creating data or gathering data that then can be used for policy making and used to alter some policies and make them more favorable for the creative sector. So our research and insights arm does that. And so recently we've done a COVID-19 impact survey on the creative industries, where we tried to understand.
Okay.
We try to understand what the impact has been, which sectors have been affected, extremely affected, and which ones still kind of show some resilience. And from that, we're able to come up with recommendations for what governments and artist organizations should do. And so, oh, I was speaking and I forgot to use my slides. So this is what we do. We offer finance through our 3 funds. That's the seed fund, the SME level kind of financing, and the growth fund financing. We do capacity building and market access, technical assistance, and business and enterprise training skills. And then we do research and insights, which we help governments, our own government and governments around Africa to understand the creative sector better and to develop policies that will lead to the advancement of the sector, as well as use the same insights that we gain to advise on our investment strategies and our approaches to investing around the region. And so during this time, Heva Fund has come up with a resilience and recovery strategy for the creative industries in Kenya. What we are mainly focusing on is these 3 aspects, where we are aiming to ensure that businesses have a lot of capital retention, or at least put efforts in ensuring they are not losing their capital. And then we also are pumping in patient capital, where we try and I'll discuss this later on, we try and give businesses better models and better facilities where they're not draining their cash flows and they're not being strained. We are also supporting businesses to pivot into areas that are currently under demand, such as PPE and the digital space. Sorry. So I will discuss these 3 strategies for resilience and recovery by using a business case scenario. So, for instance, we have this XXX Fashions. This is their income statement, where they sold 100 shirts, 50 dresses, and their total revenue amounted to 125,000, if you're able to follow my cursor. And then they have the cost of goods sold, where it's materials and labor, and the total cost of goods sold came to 70,000. And so their gross profitability was 50,000. They then had expenses for a director's salary and rent. And so these total expenses came to 30,000, which brings the total profitability for that period to 25,000. So when you look at their assets, and this is in a pre-COVID situation, when you look at their assets, their total assets level off at 135. I want you to pay closer attention to these total assets and this equity and liabilities figure, as well as this total equity. So once they made the profit of 25,000, you can see that that becomes a retained profit here on the balance sheet, and it increases the total equity from 100,000 to 125. So this is when our business is doing well, the revenues are okay, they're up to par, they're able to cover their expenses, and they report profits, and that profit grows their shareholding or their capital base. The same business, if you look at it during a post-COVID or during this COVID scenario, people don't have as much purchasing power. So the units that they're selling are reducing, and that reduces their total revenue as well. If we keep all the expenses constant, they end up with a loss or a negative net profitability of around 37,000. Notice how this loss affects the balance sheet. So the total assets immediately reduced to 72 as opposed to 72,500 as opposed to 135,000. We've kept everything constant. The only thing we've changed is that people don't have as much purchasing power, so the revenues will also reflect that. And so you can see that the total asset position really decreases. Their equity position as well decreases to 62,500. So what Heva is trying to do is ensure that this negative doesn't happen, or even if it happens, it's not as significant. So how we are doing that at the moment, sorry. The most immediate way that you can ensure losses don't happen is by reducing expenses. Say, for instance, this rent expense of 20,000. If the director was to choose to sell from their house and let go of that space, then that reduces the expenses, and the business is immediately does not bleed, that doesn't start bleeding cash and having its net asset base affected. The other option for this business is to increase its revenues. The only way to increase revenue at this point, when people don't have as much money, is to pivot. So say you are making dresses and you've noticed people don't have as much spending power, people are working from home, no one is looking for really glamorous outfits. The other way to use the material in your inventory is to, let's say, figure out how to make masks and make masks for corporates and get big clients like the government and other big corporations to supply to. And so that will be the only other way for this business not to run into losses and eat into their capital. And so what we've been doing at Heva is that we've halted all repayments. So people who owe us loans, who have to pay loans back to us on a monthly basis, we've halted that. And so at least they're able to retain more of their income in their businesses, and they're not worsening their cash positions. The other thing that we've done at Heva Fund is that we've offered patient capital. And I'll take you to this same business case, but now one that has a capital injection, a patient capital injection. If you look at the long-term liabilities, so say Heva gives this company a loan of 37,500. That loan is able, and then it's if it's patient capital, let's say we give them a repayment holiday of 6 months or a year, or we give them a convertible debt which they're not required to pay on a monthly basis, and so there's no cash outflow out of their business, there's no immediate cash outflow out of their business. So what then this does is that the total asset position, if you follow my cursor, increases to 110 instead of where it was previously after the effects of COVID at 72,500. So the business is doing much better. And then they're using these assets they're using this, for instance, if we do inject this capital, they will buy inventory. We just made a modeling case scenario. They buy inventory of this much, and then they're able to turn around this inventory, say in a month or two, and this definitely contributes to the revenue and makes this net position much better. So that's how we are also trying to catalyze this situation that we are in. The third thing that Heva is doing is pivoting, where we are supporting businesses to move into producing things that are in demand, have a lot of demand at the moment. These are things like e-commerce platforms. More people are moving to sell to e-commerce platforms, and so we are working a lot with developers and other people who have existing e-commerce platforms to just provide a market platform for other producers. We're also working with businesses to try and pivot them to PPE production and give them options to move to have digital strategies in their operations. So those are the 3 ways that Heva is helping businesses during this period, and it's something that for you as business entrepreneurs, as proprietors of your company, can also start looking into. So you can start looking into pivoting. You can start looking at organizations that are able to offer you patient capital. You can start negotiating with your financiers for more patient capital, such as convertible debts, maybe a mixed grant and debt model, maybe a repayment holiday, or maybe just pure grants if you know a place or you know an organization that's offering that. And then also try and reduce your expenses and look for other areas to increase your revenues. So I'll move straight to today's topic, which is getting due diligence ready. The overall objectives for this webinar is for you as a business proprietor to understand what information investors are looking for and why they need this information, and also to be better prepared for a due diligence process. So these are the things that we'll discuss. I'm sure we'll get to discuss all of them as we move along on this webinar. So we'll start first by defining what due diligence process is. This is a comprehensive appraisal of a business undertaken by a prospective buyer or investor to establish assets, liabilities, and evaluate its commercial potential. So by the time that you're getting to a due diligence process with your investor, you've already done a pitch and they like your business, they've bought into the idea, or at least are buying into the idea. And so they just want to seek some clarifications on what you've told them. So say you've told them your revenues are this much every year, and so they just want to ascertain that what you're saying is true, because investors have been burnt, they've been sold heavenly stories, and when the deal is done and they get to really understand what they bought, it turns out they were duped. So at least from the investor's perspective, they are not trying to discredit you or trying to find fires, but they're trying to see what could the pitfalls of the investment, where could there be pitfalls to their investment. So they're trying to see What else are you not disclosing? At least that's where they start. That's where they start the due diligence process from. But also that's not the only reason why, or at least not the only attitude or the only perspective. They also want to understand the business in a more in-depth way, and for them to figure out not only how the business operates, but how their expertise, their skills, and their experience can be leveraged during this partnership for the business to grow and flourish. And so from the investee, so from the business proprietor who's going through a due diligence process, you might want to paint a very rosy picture about your business or on your business. You might want to conceal some debts, maybe conceal some PR issues, maybe there's a disgruntled employee somewhere, or there was an exit of a partner that wasn't too amicable, and you might want to disclose this. But the thing is, by doing this, you're creating a breach of trust. And once the risk materializes from this, say if there's a disgruntled employee who comes 10 years later and causes a very big PR mayhem, then you are not truthful to your investor. And at that point, it could trigger some clauses in your investment contract. The investor could choose to pull out their fund all of a sudden, and that will have very negative implications on your cash flows and could ultimately lead to business failure. So it's very good to be upfront from the beginning, let your investor know exactly where there are issues, and then the investor can choose their risk mitigation procedures. But as just be candid and upfront, because either way, if you're really scared of losing the investment, if that thing that you're hiding should it materialize, I mean, the investor could just pull the fund and you lose the investment, and that would lead to business failure and more negative repercussions later. So it's good to start this process from a very from a point of openness and trust. And so yes.
Sorry for interrupting. May you please put the PowerPoint in presentation mode?
It's not on?
No, it's a smaller version. It's just on presentation mode on the bottom, just for it to be bigger.
Okay, like that? Is it better?
No, the presentation mode is at the bottom, close to the zoom and zoom out.
Okay.
That's right. Right at the. Oh goodness, everyone! I'm so sorry. Right at the bottom by the zoom in, zoom out. At the bottom. At the bottom? Yeah, exactly. The close notes, other side to your left.
Yeah.
Thank you.
If not, it's okay. Oh, voila. There we go. Right.
Yeah.
Sorry, everyone. And Candy, please continue.
Sure. So the first step during a due diligence process, operational due diligence. I like to call this the audit, the business model audit. So what the investor is really looking to understand, they want to understand, okay, so this business works. I mean, from your pitch, it seems like it works. They want to understand, how does it work? Does it really work? Because you could have sold a rosy picture, and that's not the case. They're just trying to get an understanding of your business plan, your business model, and they're trying to audit it and question some of the things that you present.
Hi, Candy. I think there's something wrong with your mic. I can't hear you.
Hello?
Okay, that's better. Thank you. You can carry on. Thank you.
I really have to be close to my screen. So I'm saying a business model canvas, I mean, the operational due diligence is an audit of the business model canvas. They're trying to understand, what does this business do? Who are its customers? How does it distribute its products to its final customers? How does the revenue flow in this business? What are the cost structures? What are the key resources that it uses to deliver on its value proposition? So it's an audit. What happened? Hello?
Did you stop sharing your screen?
let me try.
Voila, you're back.
I'm not able to see it on my end.
No, in this case, maybe what I can do is share the screen and, or Hanan, you share the screen and we change the, you just say when we should change the PowerPoint.
Okay.
Hanan, please share your screen and
Okay, we'll do.
Candy, let us know when to change the slides. To everyone, sorry for a bit of the glitch here. This happens, but we'll get back to it.
Okay, Kendi, let me know
Sure.
when you want me to change the slides, and I'm happy to do so.
Hanan, we are seeing your presenter mode slide. Could you go to the other one? Well, that one, exactly. Thank you.
Okay.
Okay.
And just presenter mode.
In presenter mode.
Yeah.
So, yeah. Is that working?
Do you have 2 slides on? Because we'll need to see the other. We're seeing something else. We're seeing your presenter mode. Maybe I can share mine.
Yeah, I'm not sure what's happening on my end.
Okay, if you stop sharing your screen, I will share mine. Sorry, everyone, there's some glitches here.
Okay, I've stopped sharing mine.
Okay. All right, everyone, just to let you know, this is Heva Fund, who is going to be talking with us today about the procedures of due diligence and why it's important for investors to know the ins and outs of your business. So we'll be sharing the screen again. We had a little glitch, but we'll be back at it. It's not a problem. Voila, so Candy, you were over
slide 15,
yeah,
18.
There we go.
Okay.
All right, excellent.
So saying the first process of the due diligence process is the operation.
Candy, could you go closer to your mic? Sorry.
Sorry. I was saying that the first process, the first step of the due diligence process is the operations due diligence. And what the investor is looking to see is, how does this business run? How does it work? Does it work? And so they start by, it's an audit really, but it's not it's not meant to be, to put you in a bad spot, like you feel like you're doing an exam. They just want to understand how it works and also to see areas that they can leverage in. Remember, a good investor is one who not only brings finances, but also brings some technical capacity to the enterprise or to the engagement that you guys are going into. And so by them understanding the business better, they're able to see, also to restructure your financing in a way that works for your business. Say, for instance, if your business is cyclical, maybe people buy your products when it's the holiday season probably, or when it's the season is maybe during winter, maybe if you sell like warm clothes. And so by them understanding your repayment schedule to fit with your business cycle. And so this audit process, they start by questioning, what is your value proposition? What is it that you offer people that your competitors do not, and that gives you an edge or a competitive edge in the market? So is it price? Is it that your quality is unreproachable? Is it that maybe how you offer the service, so the customer service, the customer relationships that you maintain, is what makes you a better or a desirable investment as compared to your competitor? And so, for instance, I had a client one time tell me they made bespoke clothes, and they told me the reason why they think their business has been so successful is that she refers to herself as a made-to-measure therapist. In that when clients came to her studio to get measurements for their outfits, she created a very relaxed atmosphere. It was very homey. They'd get a cup of tea. And so the women would let their guard down and talk about maybe family pressures, their kids, work stresses, and she'd feel like a therapist. And the women would keep coming. I think almost every weekend she had a packed studio because people just want to come and relieve their stress or like have a therapeutic moment, maybe while still getting their clothes measured. And so this was her value proposition. So it's that thing that you do that your competitors and can't do, and that allows you to exist in the market and to own a market share. So they want to understand that. The other thing, sorry, just give me a minute. The other thing that the customers want to, they would want to interact with that product or that service. If you say that your quality is unreproachable, they want to interact with that quality. So it's good for you to present them with variations from your competitors. Say, you see why mine, why I charge a premium on mine, or do you see why I have the market share that I have? So have some evidence to back up what your value proposition is. We can move to the next slide. The other thing that they want to know that you know and that you can articulate back to them is your understanding of your customer segments. So for instance, there are very different types of customer segments. There are customer segments who are the end users. There are customer segments who buy for the end users. There are customer segments who buy to resell to the final consumer. There are customer segments who buy on wholesale to sell to those retailers. And so you need to understand who exactly buys from you, what their habits are they price sensitive, are they quality sensitive? You also need to show, let's say for instance, someone who makes uniforms for kids. You need to demonstrate to your investor that you understand who the end user of your product is. So for someone who's making uniforms, children grow really fast. I mean, the sweater they're wearing this year is not the same sweater they'll wear next year. And so you need to demonstrate to your investor that you know that you need to make a product that's not cashmere or very high quality by using high quality materials, but a product that's able to last for the period that it is required to last for. So if it's a year, you're able to make a sweater that lasts a year and then provide it cheaply to the parents. And then you also know how to target these parents. So how do you reach these customers with your advertisements? Say maybe through radio classifieds during the rush hour when they're rushing to work and rushing back home. So you need to demonstrate to your investor that you understand exactly which customer segments you supply to, what their habits are, and how you can reach them. To even go further, it's good to have a persona of your customer. Say you make the school's uniform. You will say that my customer is called Anna. Anna is a 32-year-old lady who works maybe in corporate. She has 2 kids. She enjoys going to the mall on Saturday. So if you're looking for a way to target her is by maybe flyers, to hand over flyers at the mall. So you need to be very aware of who you sell to, what segments they fall in, and what their habits are. The other thing that the investor is looking to see that you understand is your customer relationships. So from the moment, say you have a store, yeah, you have a store where you sell to people directly. From the moment that a client stands in that shop to give you their debit card or to give you their cash in exchange for your product, they've been through a journey. They probably saw your item being sold on Instagram. They went to your page, saw what other variations of that product are. They probably went into the comments section and saw what other people are saying about that product. They probably went to your profile and checked where the location of your store is. They came to that location. They were met by a salesperson who greeted them well or didn't greet them well, who assisted them well or didn't assist them well. And so this customer journey mapping is very important. It's very important.
Sorry, can I just ask the attendees to please put their microphone on mute, please?
So it's very important for you as a business proprietor to map your customer's journey from, don't just take it up to the point where they're standing in your shop. Go back to the first time or the first instance that they interact with your product and map out that journey, standardize it, understand it, see where the pitfalls are, standardize it, make sure the one customer gets the exact same service as the next and there's no variation in quality of service. An investor would pose as a customer, or someone in the investor's team can pose as a customer, and to go through this customer journey and see whether what you're purporting to be your customer journey is actually your customer journey. So you need to be very aware of what it is, fix the loopholes, and standardize it to make sure everyone gets the same treatment and there's no variation in service or quality. The next thing that the investor would want to know is how your product reaches its final consumer. So what are your distribution channels? Do you have a final store? Do you work with a courier service that delivers your product to the final consumer? Are you stocked maybe at a retailer's or at a wholesaler's? What are these channels of distribution? The other thing they'd want to know is the cost structures. So what is the value system in your company? Are you a frills? Is your philosophy frills or is it value driven? Both are okay. They have both competent methods of running a business and of being profitable. And so you need to choose one, whether you want to belong to the luxury market, niche market, or you want to capitalize or make sure that your products and your services are really mass market. And so once you are aware where exactly you fall, you also need to categorize your costs into fixed, into variables. And this is very important, especially when it comes to financial modeling, which is a process in the due diligence process. So by knowing exactly which categories of costs are fixed, let's say the rent is fixed, the marketing cost, whether you sell or not, you have to pay your marketing consultant, or maybe you've put aside a certain percentage to go towards maybe social media marketing, or which other costs, let's say, vary with your production, say the cost of materials or the cost of inputs, those would vary. So it's very good for you to have an understanding of which ones are fixed, which ones are variable, and to articulate this to your investor, because they're going to use this for financial modeling to ascertain how much level of debt you can carry in your business, and to ascertain which mode of investment is favorable for you. Is it a convertible debt? Is it a lease to own kind of arrangement? Is it a revenue share model? It's very important that you understand these cost structures and articulate them to your investor. You also need to understand whether with every increase in output, with every increase in production, whether you are saving on costs. These are called economies of scale. So if you put out, if you're selling 100 units a month already, if you're selling 100 units a month and your cost of production is 10,000, if you sell 101, will that cost of production still be 10,000? If so, it's very good to continue increasing the level of output while maintaining that same level of cost up to the point where it's optimum. Up to the point where if you make maybe the 150th unit, then your cost goes to 11,000. So you need to find out whether you would benefit from economies of scale, and then increase your production while maintaining that cost level, while maintaining the same cost level up to that optimum point. It's important for the investor to know this as well. And then the other item is revenue stream. There are various revenue streams from any business. I'll give you an example. When we were doing a due diligence process for one of our clients, we realized they have a lot of waste material. They were a cloth company. And so for them, they'd never thought of reusing that extra waste material. And then we suggested, what if you use that, the remaining material or the cut, whatever has been cut and not fit to make a full garment? What if you use it to make children and toddlers clothes, so that when a mother comes to buy an outfit, they get a mini-me outfit from that as well? And so that's another example of why understanding a business model in its entirety is very important to the investor, because from their skills and their expertise, they're able to help you tweak and see areas where you can harvest more economies of scale and economies of scope. Say, for instance, you have a huge space, a huge production space that you're not using completely. Other than you selling the products that you're producing from that space, you could also let out the extra space, and that would be an income into your business. So it's good to understand what revenue streams you have currently, and also keep exploring which other revenue streams you could add to, you could increase to or expand to. The next slide. Sorry, just hang on. Partner networks. Hang on, just go to the previous slide.
Hi, Candy. Is this
Yeah.
the right slide?
The previous one.
This one?
The one, oh no, the one after this one. Yes, so the partner networks. It's good for businesses not to operate from end to end. If you don't focus on your value proposition or on creating value.
Candy, the slide on partner networks, we have the quiz.
No, the one before the quiz.
It's business model canvas.
Yes, that one.
Okay.
So I'm discussing the point on partner networks. It's good to outsource the things that are not your key competency to other partners, so that you can focus on what you really are good at, and so that you can be able to deliver value to your final consumer. So for instance, say you're producing something, it's good to let another business deal with the logistics of delivering that item to your final consumer, so that you can focus on the things that you're really good at, and so that you can focus on delivering value to your end consumer. And so the investor will be interested in knowing which other partners do you work with, like your suppliers. What are these contract terms that you have with them? Like your landlord, what does the lease contract say? Is it favorable to the business? Is it up to par with fair market and trade regulations? And so these are things that they would need to check and verify, and go through your contracts with them, and also gain an understanding of how you're doing, how it's working between you and your partners. We can move to the next slide. This is a small quiz. I want you guys to answer on the chat box, what is operational due diligence? We've just discussed it. Let me know in your own words what you think operational due diligence is, and what does operational due diligence aim to ascertain? What do you think is the objective? What is the investor trying to achieve when they are carrying out an operational due diligence? Letitia, we can move to the next slide. Okay, the next aspect of due diligence is the financial due diligence. And in the financial due diligence, what?
Candy, your mic.
Hello?
Yes, perfect.
Okay. The next aspect is of the financial of the due diligence process, the financial due diligence, and what this entails. The investor is trying to ascertain. You detail them what your profitability look like during the pitch session. What they're trying to ascertain is verify this document. So they are going to go through your audited financial statements in order to ascertain how much profitability you made, how much was your gross profitability, your net profitability margins. They will need your latest management reports, because from say you're doing the due diligence process in September, and your end of year was last year, December. A lot could change in those 9 months, and they need to be working with the most recent financial documents to do your financial projections, to do analysis of your financial modeling, to ascertain how much debt or how much investment this company or this business can carry. So that's the reason why they need the most latest management reports. They need your financial projections, what you think after the injection of the funds, how you project the revenues, how much change you project will happen to your revenues, how much growth you project will happen to your profitability. They need to see this these projections from your standpoint. They're also trying to ascertain the revenues that you've reported in the previous year. What are the invoices relating to this revenue? So you need to have the hard copies of these invoices. You need to have the hard copy of the invoices and contracts relating to your expenses. If you have any pre-existing debt, they need to see the contractual terms of this debt, because maybe they could have preferential rights to theirs, and this definitely increases their financial risk, and they might need to add their premium to their loan or to their debt facility. And so they also need to see your accounts receivable and account payable days. This helps them determine whether you manage your working capital well. If too long to pay people, you're taking too long to pay your key suppliers, that could imply business risk, because the minute the suppliers, let's say, stop supplying you, or the minute the landlord has been owed for too long and they're shutting down your premises, that could lead to business failure, and in turn lead to the loss of their investment. They need to see your contracts with your key suppliers and your key customers, just to ascertain whether they are favorable to the business and whether they are compliant with fair trade. It's good to have letters of recommendations. Anytime you deal with a customer, make sure to ask for a letter of recommendation so that sorry, I'm getting distracted. Make sure to ask for a letter of recommendation so that at least it backs up or acts as evidence when you're doing your due diligence process. The other thing that they need is a business premise list. This is they need to know how long you're going to be in that location, what the terms of the lease are. If you need to move, are they punitive? Because all these things could have an implication on the business performance. They need to see your bank statements just to collaborate your revenues, collaborate your expenses, and just see the movement of money and such kind of things. Next slide. So the other thing that the due diligence process is seeking to ascertain, it's seeking to ascertain whether you are asking, whether your funding ask is legitimate, and not legitimate in the way that, in a way that maybe is looking to interrogate you further, or maybe they're coming from a position that you are not being truthful, or maybe you're asking for too much. They're just trying to see, where are you taking this funding ask? Is it really needed for what you're asking the investment for? So first of all, they need to determine the sustainability or the viability of the business or the new venture. So most of the times when you're applying for funding, you've run your business over the years, you've been performing well, so probably you just want to scale, or you want to go into a new venture, or into a new product or a new market. And so that's why you are seeking funding at this time. You want to scale. And so they need to see this new project that you're going into, or this new scaling idea that you have. Is it viable? Is it sustainable? How much are you asking for? How are you going to spend it? How much of it is capital expenditure? How much of it is working capital? Sometimes we've seen people ask for money to go towards, let's say, salaries and recurring costs, or founders' fees. It's not very advisable to have those to be at a significant level, or like to carry maybe as much as 40% of your funding ask, because your funding should go towards capital investment. This is funding that if it goes to capital investment, then you're assured of returns, because it has gone into something that is able to pay back, it's able to churn back money. But if you take the money to a recurring cost, that is not it's not really producing such as much as a capital asset or a capital investment is producing. It's just a recurring expenditure. It looks like you're burning money or throwing money in a pit every month. It's not advisable. So it's good that your funding ask is really geared towards working capital, because then this one is able to be churned very quickly into revenue, and it will have an immediate impact on profitability. It's good for the funding ask to go towards investment capital, because then that capital is able to be employed and churned into revenue making activities. So abstain from putting too much of the funding ask into recurring founders fees or founders salaries, or like a high expenditure thing that's very recurring. Abstain from that. The other thing that they're looking to see is whether the business is able to sustain such repayment. So if you're asking for 10 million, be assured that you'd be required to pay, let's say, 200,000 Kenya shillings, given the duration and the interest rate. Let's say it's about 200,000 shillings every month. Is your business making a profitability of above 200,000 so that it's able to repay this kind of investment? Is it able to carry such a burden of repayment? And then they also want to see the growth trajectory. So once the funds are injected, what does that do for the revenues? What does that do for the cost of goods sold and the expenses? So for instance, say if you're given 10 million as a loan, you're able to secure better terms with your suppliers. Let's say you'll buy in bulk, and so the cost will shrink, and that will impact profitability positively. So you need to detail this and explain and show evidence of this to your investor during the due diligence process.
Hi, Kendi. Just to highlight that we'll leave room for 10 more minutes for the presentation,
Sure.
as we're already starting to run a little bit over time, and then we'll leave some time after that for the Q&A.
Okay.
Okay, great. Thank you.
Also, the financial projections will help in deal structuring. So if you see that in the next, once the funds are injected into your business, maybe in the next 6 months or in the next 1 year, your profitability will have grown by this much, then they're able to, or maybe not, maybe if once the capital is injected, it will take 2 years for your profitability to be impacted in any way. Then the investor is able to structure a deal that aligns with that, with your projections. So they'll maybe require you to start making payments after 2 years. So it's very good to have these financial projections from your own standpoint, even before the investor comes with their own standpoint, because you are the one who understands the business better. You're the one who's carrying the vision of the business. Next slide. The next item is structure and ownership. So everyone wants to know in /KYC, this is know your customer. In recent years, there's been a lot of terrorism and money laundering activities, and so it's very good for every person, every business, any financial institution to know exactly who they're dealing with. An example, sometimes we think that our businesses are too small for us to be used for money laundering, or our businesses are too small for us to be funding a terrorist organization. But if I could give an example, the Westgate terrorism attack in Nairobi was funded by Kenya shillings 300,000 that was transferred through M-Pesa. So it doesn't have to be big amounts. Not when you're dealing with billions. It's not when you're dealing with billions that you should be concerned about money laundering and about terrorism and other financial transgressions. You should be concerned now, even when your business is small and lean, and you should know exactly who you're dealing with. You should know your customers. You should always have like a form where they fill in their information, their name, their physical address. Have them send you letters of recommendation from their banking partners. Just know exactly who you're in business with, whether it's a supplier or it's a customer. So most financial institutions will ask for your business registration. We want to find out when it was incorporated. They'll want to know who owns the business, their individual names, their nationalities, their physical location, just generally your IDs, your passport numbers, the gender or ownership structure, like the gender inclusion, whether there's a woman in the board, how much percentage do they own of the how much stakeholding do they have in the business. So it's very important for you to have all these registration documents, to have your licenses in place, to have all the contracts with the suppliers, with your employees in place, to have your lease agreements, to have letters from your banks recommending you and vouching for you, to have letters from your suppliers and your customers recommending and vouching for you, just for you to present a very wholesome, and not only to present, but also to evidence that you're a very wholesome entrepreneur and business. I've highlighted pitfalls that could delay the process here. So this is from our past experience. So sometimes businesses start with like 3 partners, and then one partner either leaves for another venture or something happens, and then they exit, but there's no official exit of that partner. And so when it comes to the due diligence process, you love the business, their financials are amazing, their operations and their business model canvas makes sense, and it's a business you want to invest in. When you come to knowing who you're dealing with, you find out that there's this stranger owner who used to own 10% but no longer owns it. You can't trace them. You don't know where they are. You don't know who they are. You don't have their IDs. You don't have their passport numbers. So it becomes very difficult to invest in this business because there's this one aspect that they haven't met. So what that would mean for the proprietor is that they have to go look for this business, this partner, have them sign all those documents for them deregistering themselves with the business, file that with the registrar, get the files back from the registrar, and it's quite a long process, and that would delay your investment opportunity. What you need to know, what you need to do is that anytime there's a new partner or there's any change that's happening in the business, whether you're changing your physical address, make sure to report it to the relevant authorities, your company registrar authorities, to make sure that you're always up to date, and the information that is with the registrar or is with the registration represent what's actually happening in your business or what's on the ground in your business. Next slide. This now know your consumer, know your customer documents. I touched a bit on this, where you need your company register, your tax compliance certificates, certificates showing the ownership of the business, business operational licenses, whether they're county council, whether they're from the government, fire and safety licenses, insurance policies, sector licenses for people who operate in the music industry. There are more regulators in that sector, and so you need to have these these licenses from your sector board or sector regulatory board. You need to have the proprietor's IDs, passports, and tax certificates. You need to have a credit reference bureau proprietor credit certificate, and you need letters from your bank just confirming. Next slide. Okay, this is the HR organogram. This just shows who is responsible for what in your business. I think I've done a webinar before, and they say that investors are very wary about investing in a one-man show business where you are the sole everything of the business. If you're sick, nothing happens, nothing goes on. It's very dangerous. It's good to have a team around you, whether they're part-time or are on contract. It's very good to just have a team around you so that the business can exist beyond you. So this is just to show the investor who's responsible for what is the workflow like, who reports to who's in charge of what, who are the key resource people, and if there's a system in place to train the other non-key resource people to just acquire resources and have the organization learning, the organizational learning maintained within the business, so that in case a major person, a key person leaves, they don't leave such a huge gap in the HR structure. Next slide. This is what I was talking about. Next slide. There's a small quiz here. List 4 reasons why the organogram is of importance to the investors. Uh-oh, something happened to my internet. We can move to the next slide. So IP, intellectual property due diligence. So for some companies, there's creation of IP, and so there should be some due diligence around it. The investor wants to know who owns these rights. Are they trademarked? Are they registered? Where are the certificates? If there's a third party outside your business or outside yourself who owns some rights, what are the contractual terms? Yeah. We can move to the next slide. Business stroke work environment. The investor wants to know that you're not running a sweatshop. What are
your mic just a little bit?
Okay. Your investor needs to know that you're not running a sweatshop, that your employees have good contracts, they have good working hours, they have leave pay and maternity pay, and sick of payment terms. Their working conditions are really good. They're properly lit. They are well ventilated. There's proper waste disposal. Yeah, so just a due diligence on how you operate your business, how well you do it. We can move to the next slide. SDG, the social impact approach. So for most investors, they have
your mic is a little bit low. If you could go closer.
Okay, sorry about that. So for most investors, their goals are
We've lost you there.
Hello.
A bit closer to your mic, and I think we'll be fine.
Okay, can you hear me now?
Perfect, thank you.
So for most investors want to see, other than the financial aspect of your business, the financial performance of your business, what other impact are you bringing about in your ecosystem, in your community? So how are you impacting to the social developmental goals? Which ones are you contributing to? And if you can demonstrate that contribution, the better, because then you're not just a business that's purely focused on business performance or on financial performance, but you have an impact aspect to it as well. And I always say that every business has an impact or a social impact aspect to it. There are people you've employed, there are people who you're supporting people's livelihoods by providing employment to them. If you're providing a service or a product, a school, maybe a school uniform kind of business, then you're contributing to the education sector. And so every business, if you look close and hard enough, you will see a social impact aspect to it. So make sure you demonstrate this during the due diligence process as well. Next slide. Risk assessment. So the investor needs to know, and you need to be open with them as well, which risks apply to you. So for instance, business risk, if you're not able, or maybe you're highly leveraged, or maybe your working capital isn't as sufficient as it should be. Maybe you have a lot of money tied up in debtors, and you owe creditors a lot of money. And so there's a mismatch there in your working capital. You need to be very open and say what risks you face. You need to be very clear. If your business is a seasonal kind of business, you need to be also very open with that, because then it goes back down to how they restructure your facility. If maybe you run a cyclical business and your revenues only happen at the end of the year, there's no reason why you should be repaying a loan every month. And if you get a good investor, and every investor will be amicable to restructuring the repayment terms to fit your business profile or to fit in within your risk profile and your financial risk and business profile. Yeah. Next slide. How you need to have a risk matrix during the due diligence process. This is a matrix that helps you identify your risk factor. It helps you determine the likelihood of this risk happening. It helps you have a background to why the risk would be happening and the impact of this risk once it materializes. And then you can come up with mitigation response. For instance, if you have a risk like fraud, so you identify that as fraud, the likelihood of it happening maybe is not as likely because you trust your employees. But the background to the assessment of the likelihood could be that you deal a lot with cash. So there's a lot of cash moving around in your business. People pay in cash, you buy things in cash. And so that's the reason why this risk is happening. The impact of you losing the cash would be significant because it will impact your revenues and your profitability. A way to mitigate or a way to have a risk response would be ensuring that people pay you either through M-Pesa and minimizing a lot of cash transactions. So just have a risk matrix identifying this and then having a response to this kind of risks. And next slide. Sorry, I'm rushing a bit. Yeah. Over to you, Hanan. I think I'm done with the presentation.
Okay, thank you so much, Kendi, for the insightful presentation. It was very thorough and gave a lot of good detail about Heva and your offerings and due diligence process. So I'm sure the participants enjoyed it as much as I did. So we're going to have a Q&A session now. Unfortunately, because we've run over time, we'll keep it to a few questions only. So if you'd like to jot down any questions that you have in the chat box, and then I'll relay them to Kendi. Also, we're going to have a questionnaire. It's just a quick questionnaire that we're going to post, and it'd be really good if you can answer these questions after. It helps us to improve our service and our product that we provide to you and help make these webinars going forward. So yes, if you have any questions, please feel free to raise them in the chat box.
While we wait, I just would like to tell everyone this is your opportunity to ask questions about due diligence if it's not clear, because this is an essential process needed to get finance. So we have an expert in the house. If something wasn't clear, you have additional questions, please feel free and use this opportunity. Thank you.
Okay, so we have a question from Lisa Kibutu, and she asks, do you fund all stages of the business? Over to you, Kendi.
We have different levels of financing. We have seed financing for very early stage businesses. We have the medium level for financing for businesses. Let me just go back to seed and say that for seed, we give from USD $5,000 to $10,000. And then the medium level financing, we give $10,000 to $20,000. And then for the growth fund facility, which is across East Africa, I should mention that seed and medium level are majorly centered in Kenya. But for the growth fund, we're opening it up to the East African region. And that one we offer from $20,000 US to $100,000 US.
Okay, thank you for that. And Stephanie asks, how about commercial due diligence as well?
Commercial due diligence, the financial one? I think commercial on both the finance and the operational aspect of the business. We touched on it earlier, where it's an audit of your business plan and an audit to see whether what you've stipulated in your financial is really actually the case, and just to determine your financial performance and your operational performance. Yeah.
Okay.
So commercial due diligence is the umbrella name for both operations and financial.
Okay, thank you for that. And I'll take Preeti's question, as it seems to be the last one. And she asks, do we have to have a Kenyan a Kenyan Builds associate to get seed funding?
Sorry, do you need to have a Kenyan? Do you need to be Kenyan? Is that the question?
Preeti, would you like to expand on that? You can unmute your mic just to elaborate just for a little bit.
Can you hear me?
Yes.
Yes, we can hear you. Thanks.
What I meant was, since you are based in Kenya, do we need to have a Kenyan business associate to get the seed funding?
The seed funding is mostly for Kenyan businesses. It's actually purely for Kenyan businesses. So you
All
need to
right.
be registered in Kenya. But what's available for the East African region is the growth fund, the bigger fund, where you can access from $20,000 US to $100,000 US if you're within the East African region.
All right. Okay. Thank you.
Okay, unfortunately, that was our last question. Thank you so much for your time, Kendi, and we really appreciated the presentation and the detailed answers that you gave. And Leticia, from your end, are you happy to populate the questionnaire?
Yes, there's just one more question which I think is quite relevant for Candy, especially because this is focused on the with artists. Candy, this comes from Deborah. She asked, kindly expand on what kind of artists get grants. Do you also provide grants? Please, can you clarify that? And then we're gonna have our poll. And if everyone could just take 30 seconds to 1 minute just to fill out this poll would really help us with our activities under SheTrades Invest.
Yes, we do offer grants. The seed financing level, we do a mixed model where we offer 50% in grants and 50% in debt. In the few weeks to come, we're going to offer a COVID resilience grant to artists. And these are any freelancers who have been affected and can't work during this time. They'll be able to access around $500 US per artist. Just keep in touch with our socials. You could follow us on Facebook just to see when this information goes live. But in the next 2 to 3 weeks, it should be live. We'll take applications from artists and shortly after do the disbursement of the grant facility.
Okay, great. Thank you for that, Kendi. And Leticia or Kendi, do you have any final words that you'd like to give out to our participants?
I think mine is just to wish you guys well. These are difficult times. They are very unprecedented times. But the main thing that you could do to ensure recovery and resilience during this time is just ensure that you're not bleeding out your capital. So keep your expenses to a minimum. And also if you could find alternative revenue streams or pivot in a way that you're able to earn revenue from other things. It could be your machines that you could hire out when you have downtime. It could be maybe your truck that you used to deliver that you could now start delivering for other people. Just explore ways you could earn revenue with what you have currently, and ensure that you're not bleeding out your capital. Pivot into what's on demand right now, and just negotiate also better terms with your financials, with any financial institution. Just if you're looking for a loan or any kind of financing, be very adamant and aggressive in negotiating for longer repayment terms and just getting better debt contracts.
Excellent. Thank you so much, Kendi, for this webinar session. It was really informative. And thank you so much, Hanan, for taking the lead with this presentation. To everyone, this is Leticia Johnson speaking. I would just like to thank you everyone for taking the time today to attend this webinar. And if you've attended the previous webinars, I also thank you too. This is the close of our first session of the webinar series, Coffee with Our Financiers. We are organizing more webinars with our financial institutions. We are targeting countries in Nigeria, in Ghana, in Kenya, so and globally as well. So please do stay tuned onto SheTrades.com. If you haven't registered, please do register. If you're looking for finance, please do apply to SheTrades Invest. We have the application forms in English, French, and Spanish. And just to let you all know that this the application form on SheTrades Invest is ongoing. There's some investors that will be interested. Some investors have different investment criteria, but if you have your profile, we can then scan it and connect you with the right financiers. But for now, we will be continuing with online technical assistance. So this is a webinar, and we'll also be communicating with you the launch of the third e-learning course that is on how to fundraise for your business. But if you've applied to SheTrades Invest, or if you are in this registration form, and if we will be communicating with you shortly. So to everyone, thank you again for your time. Hanan, Candy, thank you so much. And I would like to just, wish you all a happy morning, afternoon, or night, depending where you are. Thank you everyone for taking the time also to fill out the evaluation form. I'll leave it for another minute, but you're also free to go. We will be sharing with you the webinar recording and the PowerPoint presentation. Thank you, and that's all from my side. Hanan, do you have any final words?
You've given a good closing remark, so thank you for that, and thank you all for attending, and I look forward to hopefully more of you guys joining in the next upcoming webinars. That's it from my end. Thank you.
All right, I'll just stop recording now. Thank you everyone, and enjoy your day.
Thank you, bye.